Hello everyone. If you've spent time in quant finance, building alphas, crunching big data, deploying algorithmic strategies, maybe high-frequency trading, you probably feel like the bar keeps moving. If machine learning, big data, and HFT are the current cutting edge, what's next? Over the next 10 years, what will reshape quant finance in profound ways? What next big thing is coming? What trade-offs it'll force on us, and what you need to watch or build toward to stay ahead. Let me take you through what I believe are the candidates, their promise, their pitfalls, and what your strategy should be. First, think quantum computing and quantum machine learning. I know, sounds sci-fi. But multiple recent academic works, vendor reports, and central bank, regulatory documents consider it more than speculative. For problems involving huge dimensions, path-dependent derivatives, many risk factors, or costly Monte Carlo simulations, quantum methods and hybrid quantum classical models are showing potential sample size or latency improvements. For instance, a recent review found that quantum Monte Carlo amplitude estimation methods can cut down required sample sizes by up to about 4 times, compared to classical Monte Carlo under favorable conditions. That said, the hardware is still limited, noisy qubits, error correction not fully mature, cost high. So for most of the next decade, what we'll see are hybrid quantum classical approaches, where you use quantum subroutines inside largely classical systems. Portfolio optimization under constraints, tail risk measures, VAR, CVAR, derivative pricing of very complex payoffs are likely early winners. Firms that begin experimenting now, building small quantum proof of concepts, will have an advantage once qubit count and fidelity improve. Second, reinforcement learning and dynamic decision-making, especially when paired with transfer learning, meta-learning, multi-agent settings. The survey, The Evolution of Reinforcement Learning in Quantitative Finance, 167 publications, highlights that many academic RL approaches are promising but fail under real-world constraints. Non-stationarity, cost of simulation, realistic execution frictions. What seems to be moving forward? RL frameworks that incorporate risk control, not only return maximization, that are robust to regime shifts, that incorporate realistic costs, slippage, transaction cost, and that can transfer from one asset class, market to another, transfer learning. Also, meta-learning or lifelong learning where the system learns not only a policy but how to adapt when conditions change. Within 5-10 years I expect RL to be a standard part of the quant stack for execution algorithms and adaptive strategy switching. Perhaps less for raw price prediction, still very hard. Third, large language models, unstructured data, signal augmentation. Many quant strategies already incorporate alternative data. News, filings, social media sentiment, satellite, geospatial inputs. But LLMs open up new possibilities. Parsing unstructured texts, summarizing risks, automating event detection, extracting themes. For example, FinGPT, open source, shows how one can build LLM-style models trained on financial data to do things like robo-advising, signal generation, low-code strategy prototyping. But again, signals from unstructured data have noise, can be manipulated, decay quickly. Also, using LLMs tends to reduce transparency, plus latency and cost of inference may be non-trivial, especially if you're using heavy models. One mitigation is combining structured plus unstructured signals, and having human-in-the-loop validation, plus rigorous backtesting that includes data lag, as well as avoiding over-reliance on hype sources. Fourth, benchmarking, reproducibility, robustness, risk control are not add-ons, but will become foundational. Simply put, many academic papers show large backtest returns, but when you add reasonable costs, slippage, regime change, the edge often quickly erodes. The FINRL contests are a recent symptom of this. They bring researchers together to test under more realistic constraints and share data, tasks. So over the next decade, firms, and even funds with small budgets, that invest in better infrastructure, realistic simulation environments, stress testing, data pipelines that include dark times, regime shifts, realistic cost models, will have a competitive advantage. Also, being able to explain, audit, and validate your models will matter much more, especially as regulation tightens. Fifth, regulation, explainability, ethics, ESG will not be peripheral. They will drive what is feasible. Not only because laws and regulators demand it, but because stakeholders, investors, public, boards, demand transparency and responsible risk. Some of the vendor trend reports show that regulatory concerns around black box models, fairness, data privacy are rising fast. Also, ESG, climate risk quant strategies, non-financial risk, cyber, operational, climate will increasingly be embedded into quant risk models. Alt data linked to environmental, social risks, e.g. satellite imagery of pollution, carbon emissions, supply chain disruptions, are already being used. But data standardization and verifying the quality are hard, so there is both opportunity and risk here. Sixth area. DeFi, tokenized assets, new asset types, blockchain. This includes algorithmic trading in crypto, smart contract-based automated market makers, AMMs, tokenized securities, potential new liquidity venues. These are somewhat more speculative, or risky, due to regulatory uncertainty, technology risk, security risk. But they provide new playgrounds for quant research. Also new forms of market microstructure, on-chain, decentralized, new forms of data. If you are in quant finance, even if you don't trade crypto, understanding this world seems prudent. Some trend reports pick up DeFi plus quant as a part of what's worth watching. Risks, mitigation, and what you should do, practical advice. Because not all promising ideas will pay off. Here are some of the biggest risks, plus how I believe prudent quant teams should mitigate them. Risk of hype, overpromise. Many papers promise large gains under idealized conditions, almost no cost, no slippage, perfect data. Mitigate by always testing under realism, transaction costs, latency, data delays, regime changes. Data quality and freshness. Alt data often has missing values, bias, delays. Have strong pipelines, data validation, and plan for model degradation or retraining. Hardware, infrastructure requirements. Quantum hardware is expensive, immature. Deployments of LLMs cost inference time and resource. Use cloud, hybrid infrastructure, prototype small, monitor costs versus benefit. Regulatory and compliance risk. If models are opaque or unexplainable, you may run into regulatory barriers. Build explainability tools, maintain audit trails, design models with interpretability in mind, or at least with methods for post-hoc explanation. Overfitting, regime shift. Use robust cross-validation, out-of-sample tests, use meta-learning, transfer learning, stress test against historical crises and hypothetical situations. What this means for your strategy over the next 10 years if I were you, or advising quant teams, here's what I'd focus on doing now to be ready, ahead. Start small proof-of-concept projects in quantum or at least quantum classical hybrids. Even if gains are small now, building expertise will pay off. Invest in RL research with realistic constraints. Build internal benchmarks or participate in public ones. Invest in systems that allow fast experimentation with simulation plus live data. Build pipelines for unstructured data plus LLMs, news, filings, alternative data. But treat them as augmenting core signals, not replacing them. Build or acquire tools for explainability, model governance, auditing. Monitor regulation closely, AI law, data protection, quantum regulation etc. And ESG, climate risk standards. These may become binding in many jurisdictions. Keep an eye on new asset classes, especially tokenized assets, DeFi, on-chain markets. But only engage where regulatory and operational risks are manageable. Security, operational risk. Especially in DeFi, blockchain domain or in any system relying on external data, APIs, alt data. You have risk of malicious manipulation, latency, downtime. Build redundancy, validation. Conclusion. So, to pull it all together, The next big things aren't one single, magic bullet, but a convergence of several. Quantum methods, reinforcement learning, especially adaptive, multi-agent, transfer learning, LLMs plus unstructured data, and improved robustness governance will together shift what's feasible in finance. Over the next 5-10 years, the gap between research promise and production reality will narrow. But to capture that, you'll need not just good ideas, but infrastructure, risk consciousness, regulatory awareness, reproducibility, and modest humility. If you build toward that convergence now, you won't just keep up, you might be setting the next edge. Thanks for watching. If you found this useful, please subscribe, share, let me know what you think is missing. I'd love to hear from people working in firms about what they see already moving in these directions.